Your investments are there to build you wealth, but the problem that most people have when it comes to investing is they don't have any sort of strategy. They look for the next hot stock, you look for the next hot cryptocurrency, you look for this next thing on Reddit or internet or whatever some random person on YouTube is saying, and then you throw your money into this thing hoping that you're going to double your money, and then when that does not happen, you hate the stock market, you hate the economic system, you think everybody is rigged, and you don't understand why everybody else is getting rich except you. And this is where we gotta take a step back and understand what is your strategy. What do you want to invest in and how do you want to invest? Now, you can invest in real estate, you can invest in stocks. I really don't care. Those two have been the proven assets that have been time-tested, stocks and real estate. But you gotta start with a strategy. Do you want to be more of an active investor or do you want to be more of a passive investor? This applies to real estate and stocks. Active investing is what most people think about when you talk about real estate investing or stock market investing. In the stock market, active investing means trying to find the next company that you want to invest in. You're looking for a shift that you believe that more money is going to flow into technology. Okay, more specifically, you believe more money is going to go into artificial intelligence. Okay, more specifically, you believe that these companies are going to profit from this shift in money over the next 5 or 10 or 20 years. And now you go out and you invest in those specific companies or funds related to that shift. That is an active investment. I'm not talking about trading. I'm looking for finding a company that you believe is going to be able to see the upswing. That way you can take on more risk for more potential return. Key, more potential return. You're hoping to make more money because you're taking on more risk, but here's the problem. Let's say you invest your money into Amazon, and over the next few years you keep putting more money into Amazon because you believe that Amazon is going to take over the world, but then the CEO does something bad with Amazon. They start to see the profitability fall. They then start to get hit with lawsuits. They then start to get hit with the FTC regulations, SEC regulations, and new regulations by the government, and then they have to file bankruptcy. Not only did you not make any money, but you lost all the money that you invested. More risk for more potential return. The alternative to an active investment is a passive investment, where now instead of trying to find the next Amazon, you're just putting your money into something like the S&P 500. The S&P 500, for example, is a group of the 500 largest companies in the stock market. This might include companies like Amazon, and McDonald's, and Coca-Cola, and Apple, and Nike, and Nvidia. And now you don't have to worry about managing it because it's an algorithm that's giving you exposure to the 500 largest companies. So now if Amazon were on the verge of bankruptcy or is going bankrupt, it would get kicked out of the fund and replaced by another stock, and there's nothing that you have to do. This is called passive investing. And when you do this type of passive investing, the way that you win is by doing something that I call ABB, always be buying. You set up a system so every week, every 2 weeks, and every month, you just keep buying. No matter what, whether markets are up, whether markets are crashing, you keep buying. Whether it's a Republican in the White House, whether it's a Democrat in the White House, you keep buying. Whether it's raining, whether it's snowing, whether it's sunny, you keep buying. That's the way that you win, assuming that you do it for the long term. By the way, there are funds that give you exposure to the S&P 500. A couple examples are SPY and VOO. Those are both ETFs, funds that give you exposure to the S&P 500. I'm personally invested in VOO as a disclaimer. Now, I gotta also remind you that investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Now you might be thinking, well, Jaspreet, what if I wanted to invest in real estate? It follows the same pattern. If you wanted to be an active investor in real estate, this means you're gonna go out and find a deal. Maybe a single family house, maybe an apartment complex, maybe an office building, maybe a retail building, maybe a mixed use building, maybe an industrial building. You find a property that you wanna buy, it makes sense, you do the underwriting, and then you go out and buy it. More risk for more potential return. The alternative to be a passive investor in real estate is to find somebody else's deal, to find a crowdfunded deal, to find some other sort of syndicate deal where you're investing some money, but it's managed by somebody else. These types of deals are everywhere. You can go to a real estate investor conference. There are companies on the internet. You can use my link down in the description to see one of my affiliate partners that can give you exposure to this type of real estate investing, where now you're just investing some money, but you're not the one that's actually managing the deal. It's more passive. So, active investing is you are the manager of this investment. You're still a long-term investor. Passive investing is somebody else is the manager and you're just investing your money, less risk for less potential return. The second thing you want to do to optimize your investments is now research. This is even more important when you're an active investor, but it's still important as a passive investor because you got to research what your investment is. The way that you can improve your returns as an investor is to find a better investment. And how do you find a better investment? It's not just by listening to a random person on YouTube. It's by actually doing the research. It's by actually doing the work. This is what Warren Buffett does does all day and night long is he's researching companies. This is what our market analysts at my company, Briefs Media, spend all day doing. They are researching trends, they're researching shifts, they're looking for where the money is moving, and then we publish a report in Briefs Pro which breaks down where we believe the money is moving. Again, if you were interested in learning more about how you can be a better investor and what's happening in the markets, you can join Market Briefs for free and get our investing masterclass. And then if you are interested in Briefs Pro later on, you can always join that to get access to more research. But the whole idea here behind your research is to have a reason for investing in whatever it is that you want to invest in. Instead of just throwing your money into random companies, you're researching where you believe you will see the most upside. The better your research, the better your potential returns. I always say potential because sometimes you can get lucky and find a great investment. Sometimes you can do all the research in the world and be wrong. That's the name of the game when it comes with investing. But you can lower some of the risk by investing more time into your research. And then the third part is to actually execute. And what I mean by that is sticking with your strategy for the long term. Anytime you see a market downturn happen, we've seen it happen in 2025, we saw it happen in 2022, we saw it happen in 2020, we saw it happen in 2008, people panic. People freak out. And then they forget, number one, they forget their strategy. They assume now that the world is going to end, the economy is going to end, everything is going to go down, and people panic and they sell and they run away, and then they lose a lot of money. And this is where you have to remember your strategy. You have to remember that your goal is to be a long-term investor, and when things go wrong, go back to the strategy. If you know what it is that you want to invest in, and you see some great investments at a discounted price because people are panicking and selling, that could create a great buying opportunity, because recessions and market crashes create more millionaires than any other time, because they allow financially savvy investors to come in and buy great investments at a discounted price. Let's talk about how do you optimize your savings, because your goal isn't to just save a whole bunch of money forever, because we know the savings generally lose value to inflation. The goal is to have a system, a goal, a strategy with your savings as well. And what I like to say is you want to save somewhere between 3 and 12 months worth of expenses in your savings accounts. And the amount of money you save is going to depend on where you are in your financial journey. If you're 25 years old, you're not married, you don't really have any financial responsibilities, you don't need 12 months worth of savings put aside unless you're really scared of risk. But you might only need a few months worth of expenses because, well, you don't have that many financial responsibilities yet, so you can be more aggressive with your investments, which will help you build even more wealth. But now if you're 45 years old, you got kids, you got parents that are getting a little bit older and you have to help take care of them, and you have these other financial responsibilities that are now kicking in, maybe 3 months isn't enough. Maybe you need 6 months or 9 months or a year's worth of expenses put aside to make you feel whole and comfortable. That way, if you got fired from your job tomorrow, you wouldn't have to stress about how your family's gonna eat. You wouldn't have to stress about how you're gonna pay your bills. You wouldn't have to stress about just living life. You could take some time, find a new job, and get your family back on their feet because you have that savings cushion. That's why you wanna have your savings. That way, if something bad were to happen, you don't have to panic. You don't have to go into a credit card debt. You have the cushion to protect you. That's why you want to have somewhere between 3 to 12 months worth of expenses. After a year's worth of expenses, this is where I would take that extra money and just dump it all into my investments, because now I no longer need to save more money. I can take all this money that I was saving and put it into my investments because I have enough cushion now. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.